Another caller on the line, Julie from Sydney. Julie, what's your question for the panel?
My question is, my husband's looking into buying a Defence Force house for tax purposes mainly, and the thing that's attracting, well, both of us to it is that we purchased the property and it's actually rented, a guaranteed rent for 12 years. And my question for the panel is, are there any downfalls or pitfalls in purchasing Defence Force properties?
Yeah, great question there. What are your thoughts, Robert?
It's a great question for Julie. Julie, the way the Defence Force housing works is that you're indirectly providing for some of their lieutenants or sergeants, whatever it might be. Instead of them buying the property, you're pretty much providing the housing infrastructure for them. So in doing so, the lease is pretty extensive. It sits at about 2.5 inches thick, and what you need to probably be aware of that if you were to sell that property, that lease just gets registered on title. So therefore, you could only on-sell that property to a particular investor, and that investor would need to take on those pre-existing lease conditions that you've already got in place with the Defence Department, Defence Housing Authority. But in saying that, it's probably one of the best investments that you can make. The reason for that is there's literally no vacancy factor. Whether they've got someone living in there or not, your rental income comes in from the government. So your rental return is pretty much guaranteed. And in addition to that, because it's an actually extended lease, which is one of the longer term leases, at the end of that lease, they even go to the extent, well, they used to a couple of years ago, I'm pretty sure they still do it today, they even go to the extent of recarpeting and repainting it. So they pretty much return the property in tip-top condition for you. You've got low vacancy rates, but their management fee for managing that is a little bit higher than the normal management fee. But overall, it's a great investment. So yeah, it's a good deal for you.
Yeah, just interested, I think you touched on southeast Queensland before. I've got two properties, one in Eagleby and one in Drewvale. They're new properties and both 4-bedroom and about about 350,000 both of them. I'm just wondering what the panel thinks of those two areas in the next sort of 5 to 7 years, the growth potential.
So do you know anything about that area?
With the price bracket that Andrew's in, Andrew, you're in a price bracket where people are coming into that price bracket, whether they're coming from the southern states, whatever it might be, where they're probably getting closer to the 500 mark being the sweet spot for the property, say in Sydney or Melbourne, and that's probably not even having a 4-bedroom house that you've got over there. So you'll find that going forward, and being a 4-bedroom house, you're catering for the growing family too. Are you considering keeping the house, or are you considering selling the house?
No, I'll be keeping it.
Yeah, no, so
a sort of 10-year horizon type thing.
That's correct. So I think you'll be going okay. You've got the right property for the right area with the right demographics that would cater for that sort of property in that area. So one of the most important things when you're looking at where you're buying is saying, what sort of demographic do I appeal to, and what sort of people want to live in my area? And for the top property you've got in the area that you're at, you're right on the money. So if I was you, you're on a winner, so just stick to it.
And I think one of the things too, which I'd like to add, is that the area that you are in is one of the fastest growing areas in southeast Queensland. There's certainly plenty more capital growth to come, but one of the other things that's happening in that area is that the yields are increasing incredibly just in the last 2 years, and they're certainly on the upward swing to increase even more. So it's a good area to hang on to, I think. Okay, we have Graham from Sydney. Are you on the line, Graham?
I am, Margaret. Lovely to see you in the host chair.
Thank you. I hope you're enjoying it. I haven't messed up too much yet.
Oh, not yet, no, don't. I've got my own house and I've got an investment property, but because I had an ABN, I could only get 80% on my own house and 73% on my investment property. But I'm a casual teacher. I'm employed by the New South Wales Department of Education, and a friend suggested that perhaps because I'm employed by the Department of Education, I could apply actually for a full doc loan because I am not self-employed at all. Now, is this possible? Because it would make a great difference in my available equity to the tune of about $120,000.
Okay, I think we might just go to Robert on that one.
Yes,
He's
Graham.
our mortgage expert.
Yep, can I just ask a couple of questions though?
Sure.
How long have you been a casual teacher for?
About 15 years.
Okay, that's exactly what I thought. Now, his history tells us that casual teachers, even though the terminology is casual, that they generally move you guys around where there's someone on maternity leave or whatever it might be. And if we can show a trend, and that is, say, a couple of group certificates showing that last 2 years you earned X, and that's consistent, then we get some current pay slips. Those current pay slips would validate, one, your current income, but also your year to date. We can go into bat for you and actually get you that 90% that you're looking for. So what you'll find is teachers are of a unique breed that we know that we have to have them, and with young teachers coming on board, they go off on maternity leave or there's teachers moving. You guys are in great demand, you do a great job. So most lenders, or the astute lenders, so to speak, actually recognise and appreciate that, and there's no reason why you shouldn't be able to get 90% to gear up your investment properties at 90%.
And I wonder, Graham, if we should ask Robert who the astute lenders are so that we know who you should go and apply to.
What you can do, you can give us a yell. You can go to amo.com.au or you can ring 133 AMO and we might be able to guide you in the right direction.
And there's the plug. And we have Patrick on the line from Mandurah. Hello, Patrick.
Hi.
How's it going over there in Mandurah?
Not too bad.
Excellent. What can we do for you?
Just wanted to find out from the panel. I've got 5 properties, and the 5 properties are actually under one bank jurisdiction. I'm just wondering, is it wise to sort of use multiple banks when you're investing? Because at the moment I've got 5 properties with this bank, and I'm thinking I should go probably have another bank as if I'm going to invest again as my bank.
Okay, now this seems like another question for you, for you, Robert, but I'd like to just say something about that before we do throw to you, and that is that there is a lot of questions out there about whether or not you can use a lot of lenders or whether you should only use the one bank, and I've certainly read a lot of articles about the fact that people are saying how at risk you are when you only use the one bank. Well, I'd like to say that if you feel that only using the bank puts you at risk, imagine what it's like when you use many banks. To me, if you're going to be at the mercy of one lender, that's a lot better than being at the mercy of many lenders.
Yeah, there's 2 ways to look at that, Margaret. That could be a double-edged sword.
I'd be interested to hear
from
your comments.
From a lender's perspective, because don't forget I used to work for the lenders before, now I work for the consumer. But the difference is that a lender, depending on the loans officer that processes your loan, if the loans officer that processes your loan has got a comfort factor and actually understands investment, like Patrick's obviously an investor, their comfort factor sort of maxes out at a certain level. And that's generally, say, 1, 2, sometimes 3 properties at a very comfortable rate. Depending on the loan to valuation ratio, and also then depending on Patrick's concentration of risk. And the other thing, Patrick, is are they all cross-securitized? In other words, does that lender, because every mortgage is an all-mortgage clause, but have you got one mortgage covering all 5 properties, or are they 5 separate mortgages for each individual property? Do you know the difference between cross-securitising and standalone?
Yes, I've got, I think, 3 are cross-collateralised, and I think 2 are standalone at the moment. They're not being used.
You know, there's nothing wrong with cross-collateralising.
Well, I'll get to that. I'll get to that, Margaret.
Let's just try and keep it a little short because we've got a lot of callers to go to. But I think
basically, where I'm headed here, Patrick, is that the reason why I asked that question, I think it's very, very important, is that if you wanted to do anything with one of those 3 properties that are cross-collateralised, you need to get consent from your lender to either sell it and pay it down or release it. And they might need to do other valuations of other properties. So the recommendation from where I said anyway is if you want to be in control of your own destiny, I would recommend from my point of view is have them all standalone. By having it standalone, if you sell that property, any proceeds or the remainder of that property, you've got complete control of that. And if you wish, you can park it off the other loans, or if not, you can use that to do another transaction with.
It's a good one for you to get advice for, certainly, Patrick, because I am probably in disagreement with what Robert has said, and I'm probably not supposed to do that when I'm the host. But
that's okay.
I would just suggest that you do get some good advice, because it depends on what you want to achieve. And certainly, if you want to continue leveraging, then there is something to be said for the cross-collateralisation, because you can unlock your equity a lot more easily as well. So let's let you get a little bit of extra advice on that one, and maybe do a little bit of reading as well. Thanks for your call. And whether you know too much about that area?
First and foremost, I'd say to Emily, depending on how much you need to spend on your renovations, it's always possible to get a separate split if you've got some capital growth in these properties. So instead of actually selling, you've got your solicitor's costs, you've got your potential capital gains tax, you've got your agent's commission that you need to factor into, multiply that by 2 if you're selling both of them. Depending how much you need to renovate your home, why don't you just organise a separate split with your lender and get him to lend you that money, keep the properties, don't sell them, and just keep on realising your capital growth.
That sounds like that might be a good option for you, Emily. Thanks for your call. From Sydney on the line. Hi, Norm.
Hi, Margaret, how are you going?
Good, thank you. A lot of people from Sydney tonight.
Yeah, that's right.
You have a question for the panel.
Yes, please. We have a house in Tempe, and IKEA is building its head office by about 2 years it'll take, but there's about 600 people going to be employed, and we're interested to know what effect, if any, that would have on the prices of value prices of houses in Tempe. That's the first question. Second question is we also have an investment department in Woollow Creek, which is just down the road, or North Farncliff. Interested to know what the future might be for that area as well.
Okay, so first of all, what do you think about Tempe and owning a house near a big factory that's about to be built?
I know both areas quite well. Tempe has historically been the sister to Newtown and places like that, because it's only 1 or 2 suburbs away. So what happened to places like Newtown 10 years ago when people moved out of Paddington and moved into Newtown, the Erskinvilles and that? Tempe is now only the next suburb away. So going forward, just on its own of the geographic location of Tempe and other places coming in there, that'll be a positive for that.
And Matthew, what impact would something like the factory have on an area like that? Without the factory, we can see that it's probably going to go ahead. What impact will the factory have?
With IKEA, the employees might be putting it together themselves. So
They're all flat
He's a
factories.
comedian as well.
I
I think you should stick to the capital growth.
Obviously it's going to bring employment into the area. People do want to live near their employer if they can. That railway station at Woollow Creek's been a good thing for Tempe, because it was a wasteland before at Woollow Creek, wasn't it? And now you've got a whole suburb there.
Yes.
It's got to help.
And you said that you also had a property in Woollow Creek, or was that Bulli?
No, Woollow Creek, yeah.
Okay.
Farncliff, actually,
Okay.
yeah.
So, and just very quickly, we've got to go to the break. Keep that one.
Yeah, I would.
You?
Yeah, Woollow Creek was built a little while ago, a few years ago. A lot of units have gone in there. The capital growth might not be as good as Tempe. I think Tempe's better capital growth than Woollow Creek.
But both probably okay. So hang on to them both.